Welcome to my daily report market analysis videos with me, Richard Perry, market analyst at Hantec on Friday, the 4th of October. We have a bit of a consolidation on markets early morning today in the European session. Nothing really doing in terms of direction. However, what we have seen in recent days is this sharp decline actually in the dollar. And that sharp decline in the dollar has come about as a consequence of two major data misses. You've had the ISM manufacturing data which fell to 10-year lows, and also the ISM non-manufacturing data which fell to 3-year lows. Really concerning slowdown across both sectors, and that really has increased expectation of rate cuts for this year and hit the dollar. Look at how the 2-year Treasury yield has fallen sharply. That is now back at levels not seen since September 2017, or October, November 2017. So basically 3-year lows, 2-year lows if I get my maths right, on that 2-year yield. So that is a really significant move, and that has hit the dollar quite hard. And the outlook is certainly shifted from what it was a few days ago, where the US dollar was performing so well, and is now back towards a key sort of moment, I think, this uptrend. And it sort of sets us up well for non-farm payrolls today, because non-farm payrolls is going to be the latest key data point that could suggest that the US slowdown is taking hold. And that, again, could reiterate the fact that the US dollar is under pressure, moves towards safe havens being the main key focus there. We saw equity markets actually, interestingly, rebound yesterday into the close on Wall Street. Arguments perhaps that the ISM data wasn't as bad as maybe it could have been, or maybe it wasn't as bad in the detail as it was on the headline. But still, I think that's probably due to the fact that I think the markets are taking it that a more dovish Federal Reserve is positive in a way for equities. I don't necessarily buy that as a long-term play, and I think that that's not necessarily going to be playing out. But I think that it's an equities rebound on the States is still a bit of a tentative move, given the fact that the US slowdown seems to be taking hold now. Anyway, looking forward to payrolls today. We've got the data at 1:30. We always look at headline payrolls. We always look at average hourly earnings and also unemployment. And it'll be very interesting to see how the construct of this payrolls report comes through today. We've got an expectation of 145 on the headline, up from 130. Now there's potential for that to perhaps miss to the downside, considering we've had a whole number of negative employment read-throughs on ISM data, on the ADP report, and also weekly jobless claims coming higher. So watch out for that, possibly missing to the downside. Also, unemployment rate at 3.7%, no change there. However, if it does fall to 100,000 maybe, what you could see is the unemployment rate rising. And also looking at for participation rate and underemployment, a couple of key factors there. Average hourly earnings as well, staying at 3.2%. If that dropped to 3.1% or 3%, that really does, again, play into a really concerning series of data points for the US economy. We're also looking out for further Fed speakers today. We've got a number of them, but obviously the key one of which would be Jerome Powell, Fed chair, but also look out for Eric Rosengren and Esther George, who dissented at the last meeting, called for no rate cuts. Have they changed their tune, would be the question there. Anyway, so my chart of the day is the Australian dollar. Now, what we've seen actually this is interesting chart here. Australian dollar weakened on the ISM manufacturing data. Manufacturing is more of a global indicator on the ISM numbers. Non-manufacturing ISM data disappointed as well, and the Australian dollar outperformed the US dollar, and we started to see the market of Aussie dollar versus US driving higher. Now this is continued into today, and we're now at this confluence level, 67.50 area, this old support area, and also this mini downtrend as well being tested. So this is a key moment. Also looking at the momentum on the marginal tick higher on the MACD lines threatening, but look at the stochastics starting to rise. The RSI 45, that got above 50, then that would again be a suggestion of a turnaround. That reaction high from the bearish engulfing candle of the on Tuesday's data comes in at 67.75. So again, a breakthrough that on a confirmation closing basis would certainly start to generate more upside momentum, generate recovery. 68.30 to 68.95 is a resistance band. This reaction high here and these old lows. So that is a resistance band overhead that you'd expect to see a recovery moving into if you saw the RSI above 50, MACD lines rising, stochastics also rising. So this is a very interesting point at which we could see an Aussie dollar turnaround, and generally speaking driven by the weakness of the US dollar. In terms of support, today you're looking at 67.35. Initially today's low. 60, there's arguably a breakout, mini breakout, 67.20 area, but 67 figure was a reaction low from yesterday as well. So a few levels to work with there, but I wish you good luck in your trading. Click here to subscribe to our analysis videos, and also go to our website where you can sign up for our webinars, one of which is our payrolls webinar today. So thank you very much, and I'll speak to you soon.